In this series, we've already looked at one type of bank account, the current account. We're going to look at a different kind of bank account called a savings account next. But before we can really understand about a savings account, and in fact many things to do with finance, we need to understand something called interest. Think for a moment about your money as something that you can rent out or lend to somebody. Let's say your friend has no money but wanted to buy a new pair of shoes. You, however, have £100 spare that you're not doing anything with at the moment. What you could do is rent out, lend is the correct financial term, your £100 to them. You give them your £100 and they agree to pay it back or repay it in a month. Now that's very nice of you, and you might do this for a friend, but it's unlikely you'd do this for some random person. However, what if there was something in it for you? What if you could earn some money by lending out your £100? Let's say you lent out your £100 to someone on the condition that they agreed to pay you back £110 this time next year. That means you'd get your original £100 back and you would earn an extra £10. What you're doing here is you're making your money work for you. Rather than being hidden under your mattress, you're using it to make more money. In this example, the £10 you have earned is what's called interest. Interest is basically how much money you get for lending someone else money. Now, it's not very easy or particularly safe to lend your money to some random stranger and hope that you'll get it back with some interest. However, banks are set up to do this, and they work very hard to make sure they lend only to people or businesses that are very likely to pay the money back. There's a problem for a bank though. Where does the money that it wants to lend come from? How does a bank get money to lend out? That is where your spare £100 comes in. Rather than sticking it under the mattress where it might get stolen, and it certainly won't be worth any more this time next year, you could lend it to the bank, and they will in turn lend it to someone else. The bank might charge the person £10 in interest for lending them £100, but they won't pass all this £10 on to you. You might get £5 and the bank would keep £5 to pay for the work that they have done. Now this is a very simplified version of how banks work, and in reality banks take money from thousands or even millions of people and lend it to others that want to borrow money. The important point to understand here is about interest. The fact that the bank will give you money for leaving your money with them. Interest is normally measured as an annual percentage. So if we take the example earlier where you lent your friend £100 and they paid you back £110 1 year later, then you have earned £10 interest. £10 is 10% of £100. So you have earned 10% interest on your £100. The interest rate in this scenario is 10%. When you put your money in a bank account, you will normally earn interest on it, but the amount of interest you earn varies. If you saved £100 and got a rate of 10%, you'd have £110 at the end of the year. If the interest rate was 20%, you'd have £120 at the end of the year. And if you got an interest rate of £30, you'd have £130 at the end of the year. Obviously, the higher the interest rate you can get on money you put in a bank, the better, as it means you get more money back at the end of the year. However, like most things in life, it's not that straightforward. You can't find a bank that will, say for example, pay you 100% interest rate and then you just sit back and watch your money double every year. Currently, at the time of recording in late 2019, interest rates offered by banks are at historic low levels, and they've been that way for over a decade. The reasons for this are rather complicated and are to do with national and international economic reasons that are beyond the scope of this video. However, the important point here is to understand that you are not going to get a 100% interest rate in your savings. You're not even going to get 10%. In fact, getting more than about 2 to 3% at the moment is a challenge. Having said that, it's still better than having your money sitting doing nothing, so it's worth looking for the best interest rate. So far, we've talked about interest rates in relation to putting your money in a bank as a saver, and the bank giving you some money, interest, for doing that. However, interest is also important if you're borrowing money from a bank. when you borrow money from a bank, it will cost you money. Say, for example, you want to buy a car and need to borrow £10,000 from a bank to do this. The bank will expect you to pay back the £10,000 over a set period of time, but they will also charge you for the privilege of borrowing money from them. Thus, in this situation, you might end up paying £11,000 back to the bank. £10,000 is the original money you borrowed from the bank, and £1,000 is what you give to the bank for them letting you borrow the £10,000. This extra money you pay for being able to borrow the money is interest, and how much you pay will depend on the interest rate you are charged. In our example with a car, if you borrowed £10,000 for 1 year and ended up paying back £11,000, this would be an interest rate of 10%. 10% of £10,000 is £1,000. The higher the interest rate on money you borrow, the more you have to pay back. So if we were comparing two bank loans for our £10,000 car loan, and one was 10% per year and the other was 20% per year, that would mean that we'd pay an extra £1,000 a year if we took out the 10% loan, and an extra £2,000 if we took out the 20% loan. Thus, when borrowing money, it is very important to look at the interest rate, so you know how much you're going to pay back on top of the original money you borrowed. In summary, as a very rough guide, you want to be getting as high an interest rate as possible when you save money in a bank account, but paying as low an interest rate as possible when you borrow money. There's a bit more to it than that in the different features and options different loans and bank accounts have, but that's a good starting rule of thumb. Hopefully, you now understand a little more about interest and how it works when you save your money in a bank and when you borrow money from a bank. Interest is one of the fundamentals of finance, and we will refer to it regularly during this series.
If you found this video interesting, please hit the like and subscribe buttons below. Also, if you'd like to be notified when I post a new video, then please press the bell icon. Finally, if you've got any comments or suggestions for future video topics, please leave them in the comments section below.